Welcome to the Investing Podcast presented by Tusk Media. This is Outsider Trading, an audio and video deep dive into the people, places, and things that we find most interesting in the market.
Hey everybody, welcome back to Tusk Media's presentation of various earnings reports. Today we're looking at JPMorgan. They kicked off the bank stocks that reported this quarter on a Friday. They reported along with PNC Financial, Wells Fargo, and Citigroup. And JPMorgan really kind of led the way in terms of performance. They have been characterized as a company that's low on drama for quite some time. There's not really as much noise nearly compared to Citigroup and especially compared to Wells Fargo. And that kind of continued through to this quarter. So it was a broad-based beat that JPMorgan had. They beat on earnings. They actually hit $2.29 a share. Estimate was looking for $2.22. And they beat on pretty much all categories. They beat on trading. They beat on consumer. They beat on investment banking was very strong. They did a lot of equity IPOs. They did a lot of advising on M&A activity. So that was a very good piece of their business. So if we kind of dive into the details here, what we see is that C&I lending, commercial and industrial lending, actually was reasonable. It was good, not great, driven a lot by M&A activity. They're looking for a little bit more of a pickup toward the second half of the year. But on a positive note, the second half of the quarter definitely trended better than the first half of the quarter. And this was true not just for C&I lending, but really across the business in general as people started to become a little bit more comfortable with the market and the economy after some more uncertainty in April. So May and June were significantly stronger, and that has continued into Q3. What's also interesting is that JPMorgan was actually able to reiterate its outlook for expenses. So even while they're seeing some nice growth, they are actually seeing some, well-disciplined expenses. There could be a little bit of room for higher than expected expenses by the time we get to the end of the year, but that'll be based because of performance-based compensation. So commercial industrial loans are actually pretty solid, and the rest of the business is doing fairly well as well. Interestingly, they're actually able to keep a lid on expenses that's coming in line with guidance. There could be a little bit of room for that to surprise to the upside by the time we get to the end of the year, but that'll be based off of performance-based compensation. So that's a good problem to have if you're having to pay higher bonuses due to better performance, and that should be accretive to earnings overall. So if we look at the commercial on the consumer side, the home business was actually okay. It wasn't fantastic. It was okay on the home lending side. The credit card space was generally pretty good. Overall, though, the revenue beat really came from trading, between equity and fixed income trading. You're talking about 70% of the revenue beat versus expectations came from that, which is good news, and it contrasts, especially on the fixed income side, contrasts with Wells Fargo, and at least in the recent quarters, contrasts with Goldman Sachs. Now, we haven't got Goldman Sachs' results yet, but it looks like JPMorgan will again outperform Goldman Sachs relative to expectations. What's really interesting with JPMorgan is they always like to talk a little more about the macro than especially other banks. JPMorgan believes that it is in a position where it has a better handle on the macro probably than the other companies involved, who are focused definitely more on themselves, whether Citigroup kind of cleaning up their balance sheet, or if you're Wells Fargo dealing with all the scandals that they had. So JPMorgan, when I was talking about the macro, said, look, we're in a solid growth period, and they don't think that we are approaching a recession. Now, they did say we're a cyclical business. If we do have a recession, we'll have to manage that. And we always continue to be aware of the risks involved, but we don't think we're near that right now. Despite the flattening of the yield curve, they think that that's Fed-induced because the Fed is hiking rates on the short end and flattening the curve. They think that the curve will steepen over the next period. And then in terms of, a lot of people are pointing to the length of time that this cycle has persisted, and that this is one of the historically long bull markets or in periods of economic expansion. JPMorgan acknowledges that, but they also said, well, for the first 8 years, we had an economy that was growing significantly slower than potential, whether it's because of regulation or what have you. It was not reaching its full potential. So we had a bunch of spare capacity in terms of growth that we're now starting to utilize and starting to eat into. So they believe that we actually have a long runway there, especially on the C&I side. Commercial real estate is kind of slowing down, so watch out for that. Autos are slowing down, but in terms of the underlying drivers, underlying economy, it looks like that's still in a pretty good expansionary period. So JPMorgan, pretty solid results. Stock is performing about in line with where it was yesterday. And we'll see what happens over the course of the remaining earnings season. But for right now, it looks like the economy is in good shape, and that improved over the back half of Q2.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are our professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.